Have you ever looked at some of the biggest, most successful companies on the planet? I'm talking about giants like Amazon or Google, and wondered why they don't pay their owners, their shareholders, a single dime? It sounds totally backward, right? Well, it turns out it's one of the most powerful wealth building strategies out there. And today, we're going to break down exactly how it works.
I mean, seriously, think about it. You own a piece of a powerhouse like Amazon or Warren Buffett's Berkshire Hathaway, and yet, year after year, nothing. No dividend check shows up in your mailbox. So what gives? Why are they hoarding all that cash instead of sharing the love? That's the big question we're going to crack open today.
Well, the answer all comes down to something called the reinvestment growth engine. It sounds fancy, but the idea is actually pretty simple. It's all about a company making a choice. Instead of turning profits into paychecks for you, they turn those profits into pure rocket fuel for their own growth. Let's see how that engine really works. It really boils down to where a company is in its life cycle. So on one side, you've got your mature, stable companies. Think of a big, established bank. Their empire is built. They're not growing like crazy anymore, so they return their profits to shareholders as dividends. But on the other side, you have the growth companies. They're like a skyscraper still under construction. They are in rapid expansion mode, and they're pouring every single penny back into the business to get bigger and to do it faster. Here's a way to think about it. Instead of mailing you a $1 check, a growth company takes that dollar and puts it on a high-speed train. And that train, it's headed straight for building new factories, funding game-changing research and development, or even buying up the competition. The whole bet is that they can turn your $1 into $5 of real company value down the line. And look, here's the math in the simplest terms. If you get a $1 dividend, that's what you get, $1. And oh yeah, you still owe taxes on it. But that exact same dollar, when reinvested by a smart company, has the potential to become $5 in share price. I mean, the difference in potential here is it's huge. Okay, so now we know why they do it. But what are the direct perks for you, the investor? This is where it gets really interesting. Let's dive into the 3 huge advantages of owning these zero-paycheck stocks. All right, first up is this incredibly powerful idea called compounding at the source. Basically, the company is acting like your own personal expert money manager. They take all the profits and find these amazing high-return projects to pour it into, growing the value of the entire company from within. Honestly, it's way more efficient than you getting a tiny dividend, paying tax on it, and then trying to figure out where to invest it all by yourself. The second perk is, for my money, the biggest one of all, tax efficiency. This strategy gives you 3 incredible powers. First, you get total control. You decide when you pay taxes. Second, your money gets to grow tax-deferred, sometimes for decades. And third, when you finally do decide to sell, you're often taxed at a much, much lower long-term capital gains rate. It's a trifecta of tax benefits. Let's just hammer this point home because it's so important. With non-dividend stocks, you are in the driver's seat. You decide when to take your profits and trigger a tax bill, not the company's dividend schedule. That level of control is just a massive, massive tool for building long-term wealth. And perk number 3 is the share buyback. This is such a clever, tax-efficient way to return value to you. The company just uses its pile of cash to buy its own shares right off the market. So the number of total shares goes down, which means your piece of the pie gets bigger. This automatically boosts earnings per share, and usually the stock price follows right along with it, all without you receiving a single taxable cent. Okay, this all sounds amazing, right? But let's be real, it's not the whole story. Every single investment strategy has a flip side. So it's time for a reality check on the risks that come with this approach. So here are the 4 big ones you have to know about. First, these stocks can be way more volatile. They're often priced for perfection, so any bad news can cause a really sharp drop. Second, you have no income safety net. When the market goes down, there's no cash flow coming in to soften the blow. Third is what's called the agency problem, and that's the risk that management might just waste all that cash on bad ideas or clumsy acquisitions. And finally, to get your money out, you have to sell shares, which could force you to sell at a bad time and lock in a loss.
This quote really just says it all. Without that steady, reliable drip feed of cash from dividends, your entire return depends on one thing and one thing only: that other people in the market will agree your stock is worth more tomorrow than it is today. It's a pure bet on future growth. Plain and simple.
So now that we've laid out the pros and the cons, how do you actually take all this theory and apply it to your real life portfolio? Let's talk about building a practical strategy that works for you. Now, check out this table. It shows some pretty common models. If you're younger, say in your 20s or 30s, you have a long time horizon, so you might go really aggressive, heavy on growth stocks. But if you're getting close to retirement, you'll probably lean the other way, loading up on dividend payers for that steady income. And of course, a lot of us are somewhere in the middle, looking for a healthy balance between the two. A really popular way to do this is something called the core satellite approach. Think of it like this. Your core is the big, stable foundation of your portfolio, maybe 70 or 80% in solid dividend-paying companies. Then you use the smaller part, your satellites, to take some of those high-growth moonshots, the non-dividend stocks that could potentially deliver those massive returns. And this isn't set in stone. Your strategy is probably going to change over your lifetime. In your early growth years, you can afford to take more risks for a high growth allocation. Then, as you get older, you'll go through your transition years, slowly and gradually shifting more towards income. And finally, in your harvest years, you'll rely on a portfolio that's really designed to produce that reliable cash flow. So if you want to find your own perfect ratio, it's pretty simple. Just ask yourself these 3 questions. First, do I need income right now? If the answer is yes, lean toward dividends. Second, am I in a high tax bracket? If so, growth stocks are your friend because of that tax deferral. And third, be really honest with yourself. Can you mentally handle watching your portfolio drop 40% without panicking? Your sleep is important too. Now, if you're just looking for a simple starting point, the source material here suggests that a 60-40 split, that's 60% in growth stocks and 40% in dividend stocks, is often considered the sweet spot for a lot of long-term investors. It gives you a really nice balance of growth potential on one side and that stabilizing income on the other. And that brings us to the final question. And this one isn't for me to answer, it's for you. Take a hard look at your own strategy, your own portfolio, and ask yourself, is it built to provide income for today, or is it really optimized to build maximum wealth for tomorrow? There's no wrong answer, but the right one depends entirely on you.